Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I'm pleased to have with me today Nick DeVito. Thank you, Nick.
Thanks for having me.
Nick is also a certified financial planner as part of our firm. Had some interesting calls over the course of the past week that I'd like to point out to all the listeners that you listeners can also be viewers. Actually had two different people that I spoke to in the last week that listen to our podcast and aren't aware that we have a YouTube channel. So the YouTube channel, if you go to youtube.com, you can just search for Financial Planning Explained, and lo and behold, there we are. And therefore, if you wanted to be able to watch it, and I think the issue was that they weren't aware, well, you can't see the slides when you're listening. And so that's a way of doing it. Or else, if you wish to, you can go to our website, which is www.maaplanning.com. That's MAA as in Menninger and Associates. How creative am I?
Yeah.
All right, so back by popular demand, we're doing another case study. So this particular case study, again, to protect the innocent and et cetera, we changed the names. We may make a few adjustments to what we encountered, but the main goal of the case study is to just come up with different topics that we see on a day-to-day basis that most viewers or listeners are going to encounter during them. So, are you ready to go?
Yeah.
All right, let's kick this thing off.
So a little bit about Betty. So she's 56 years old. She works for a large public company, salary of about $160,000. Never married. She has 2 adult children that are independent out of the house and off the payroll. And I know one thing, anytime I see someone that works for a large public company, I'm mentally thinking stock options,
Of course.
RSUs, ESPP, is that available to her?
And that's interesting because I don't know if this is a plug or not a plug, but she had seen our podcasts or listened to or seen our podcasts, and as a result had called in, and here we are, and we're helping her out.
Yep.
So, yeah, and it's funny you say that because typically when we chat with somebody first, we talk to them for maybe 15, 20, 30 minutes to just get a sense of what they have going on.
Yep.
Because that helps us be able to say, all right, get us this information in advance.
And then we can go from there.
Absolutely. And you're right. The large public corporations oftentimes have a whole slew of benefits programs, stock options and all that fun stuff that you were talking about. All right, keep going.
Yep. And I know some of her goals, she would like to retire in a few years at age 60. She came in, she says, I have all these employer benefits. How do I maximize them? How do I take advantage of my ESPP, RSUs, stock options? So we'll certainly dive into that a little bit more. And then something that's always on our mind, regardless of the situation, is tax efficiency. How do we maximize her tax efficiency? Looking at her tax bracket now, projecting it into the future, and seeing what we can do there. Furthermore, she wanted us to take a look at her investment allocation. She has been a do-it-yourselfer for a number of years. She said, hey, how am I looking? And we took a look at that for her as well.
Right. So when we see single, it immediately drives us to, we know she's relying on her income only. Okay. We know that the tax brackets are associated with single. Never married has an impact on Social Security. Okay.
Absolutely.
If one was married, it could have a different set of circumstances when it comes to claiming Social Security. And then lastly, 60 tells me over 59 and a half.
Yep. Access to the retirement accounts, but no access to Social Security quite yet. So a couple more years. So figuring out how do we bridge that gap. If you're looking to retire at 60, well, you can't claim Social Security until 62. So how are we funding those 2 years?
Correct. And so the other thing that happens is 60 is a funny age. And this is one of the things that I've encountered, I guess, just being in a business for over 25 years. I've met a whole boatload of people. And it's remarkable that 60 is ironically the time with which people start getting tired of it.
Yep. She's approaching that.
She's
It's getting there.
fast approaching it.
Yeah.
And the other thing too is that oftentimes people who come see us, in fact, we just had somebody last week, they're concerned that they don't have enough. We look at it and they have more than enough, to be able to retire. And so what this does is, with her goal being to retire at age 60, what we have oftentimes do is take a look at it and say, could you afford to retire now?
Yeah.
Because boy, I'll tell you what, if you learn that you can retire now at age 56,
Your outlook changes a little bit.
oh yeah, going to work every day has a whole lot different
Yeah.
outlook and attitude.
And you kind of touched on it. I mean, people ask all the time, can I retire? When can I retire? And the answer is almost certainly how much you need to live on. Because
Right.
if you're telling me you want to live on $50,000 a month, well, that might be a little more difficult than if you're telling me you can live on $5,000 or $6,000 a month.
Correct.
That's one of the biggest factors, if not the single biggest factor in someone's retirement, is what's their cost of living.
Correct.
So
Absolutely. And the other thing too is, and we explain to clients is, hey, great, this is a fantastic exercise to go through doing a comprehensive financial analysis. We're breaking down and looking at absolutely everything. And as it pertains to cost of living, this is one of the things that I have found is if I ask somebody to come up with what your cost of living is, they usually, if they try to do it, call it the hard way, of literally writing down everything, almost like a budget, they're usually 30% undershooting. What we tend to look at is how much you taking home now.
Yeah.
And if you're spending everything and you're not really saving, well, then that is your cost of living, isn't it?
Yeah, no, you'll sit there and you'll ask them, do you want to do it the easy way or the hard way? The hard way is you go through your transaction for the past 6 months, a year, write everything out, categorize everything. I mean, there's apps out there that you can use that kind of that compiles everything for you. Then what Mike just referenced, let's look at your bank statement from December 31st of the prior year, and let's look at it December 31st of this year. How much came into the bank account? How much went out? That's your cost of living.
That's right.
It's that simple.
And if your bank account values went up, then guess what? You're saving money.
Yep.
If your bank account values went down, then you're burning through money. Of course, you may have extenuating circumstances. You may have, paid for a wedding and hopefully the only one. There are a lot of different reasons why you could have an extraneous thing. But the other thing too is that it also gives people sort of 4 years to practice for retirement. Okay, in that, they may not know their cost of living, or they may want to start looking at it and really looking under the hood. And it's remarkable because I did it once before as well. I did it the hard way, of course. And what I found was the single largest category and I had it really categorized. I had the mortgage, home equity loan, each of the 2 cars, utilities, insurances. And I was going through every single thing, kid stuff, and so on and so forth. The biggest category was other, miscellaneous. And this exercise allows people to at least ascertain what they're actually spending money on.
Yeah.
And
So it's always a good exercise. I mean, regardless of whether or not you're looking to retire, knowing where your money's going is always a good.
Absolutely. Absolutely.
I know there's sometimes that sticker shop people will download the Rocket Monies, the Mints, and they'll see I spent how much on Amazon in this past year, and so you'll see that from time to time. It's always a good idea to get it.
Oh, it really is. It really is. And sometimes it's eye opening. Like I had it with me. It was eye opening, and I'll tell you, it was also eye opening. It was remarkable how consistent my gasoline was every month.
Yeah.
And the only time it might vary is if for some reason I did some traveling or something and I got gas 5 times that month instead of 4 or something.
Yep. Oh yeah.
So, by the way, I should also point out this is probably going to last at least 2 episodes, potentially 3, because again, we try to do with these things is we take a look at various ideas of topics that we could talk about, and that's why we use case studies.
Yeah.
So
we can jump into a little bit more about Betty herself.
Yeah.
So looking at her assets, she has about $60,000 sitting in cash and CDs. She has $100,000 in various non-qualified investment accounts, meaning just regular investment accounts, not retirement accounts. A large majority, about half of that investment account is going to be her employer stock. She has some RSUs that are unvested to her, some stock options worth about 120 grand, her home, and she does not have any debt. She worked really hard to make sure she does not have any debt. Continuing on to her retirement assets, she has close to $1 million in a traditional 401k, about $20,000 in an IRA, $1,000 in a Roth IRA, and $45,000 in that HSA. one thing that jumps out to me right away is I know it's a nominal amount, but that with that Roth IRA, seeing that there's $1,000 in there means she got that time clock started.
Right, that's correct. And that's something that I noticed.
Yep, that 5-year time clock, meaning in order for your Roth IRA growth to be tax and penalty free, the account needs to be open for at least 5 years and you need to be age 59 and a half. So that's one of my
Account funded.
funded for 5 years. But that's one of the things. Even though it's a nominal amount, it's good to see that.
And what that does is if you're, I don't know when it was open, and you always find out when it was, you want to just have documentation. And we encourage folks to have documentation of when you actually opened up the Roth IRA. And oftentimes you may not have that documentation, but if you have a statement from several years ago, that clearly shows that you've had it, because the IRS operates on the honor system, okay? And that they trust what you tell them it is correct, except if they have the reason to believe that you're not correct. For instance, they get a W-2 that doesn't match, they're getting 1099s that you didn't report, but they're trusting that you're over 5 years, if you said it's over 5 years, until they come back and ask you to prove it.
And that's why it's good to have that documentation. God forbid,
Right, exactly. So to summarize, and I was just taking a look at the notes here, to summarize, she's got about $1 million in retirement assets, most of which are pre-tax, which we run into a lot, and we'll talk about that in a minute.
Absolutely.
And then she's got about $300,000 in non-qualified or non-retirement assets. And so the pre-tax assets, I'm speaking from the point where, when basically baby boomers.
Yeah.
Now, Betty's not a baby boomer, but she's knocking on that door. Okay, she's close enough.
Similar mindset.
Right. And so we were trained in the 80s and the 90s just to bang away to your 401k, because intuitively you'd think while you're working, you've got to be in a higher income tax bracket. And once you retire, you're in a lower income tax. I mean, you're not making any money, are you?
So take the tax deduction when you're paying more tax in the bracket, and then later on you won't. Conventional thinking.
That's conventional thinking. Unfortunately, we're not operating under conventional thinking for a lot of folks, and Betty is one of them.
Oh, absolutely. And one other thing to point out, she has that $45,000 in her HSA. The HSA is one of, if not the best account from a tax perspective.
It's the healthcare savings account.
Yep. So that's so what the way the HSA works is you get a tax deduction going in, it grows tax deferred, and if you use those funds for qualified medical expenses, it comes out tax free. So it's triple tax advantage.
Right.
It's the only account that does that.
Right. That's correct, and it's a beautiful thing.
Yeah. So if you're able to contribute to one, we generally recommend you do, because the tax advantages are a no-brainer.
Correct. Now, the other thing to point out with the HSA, you only qualify for an HSA if you have a high deductible plan. Yep. And companies are becoming more likely to do that, okay? Partly because it saves them money.
And I would say with the larger companies too, I seem to see the HSA and the high deductible plans a little bit more often.
Well, it's because the larger you are, the more employees that you're paying less for.
Exactly.
Although I will say that when we looked at our own plan, surprisingly, the cost of a high deductible plan wasn't that much less. Surprising,
yeah.
Yeah, I was surprised by that. So,
yep.
Anything else that you want to talk about with regards to that?
No, we'll kind of touch on everything.
Well, actually, let's talk about this. Cash and CDs.
Okay.
Did you ask Betty what her interest rate was?
Yes. So one of the things we do, especially now in today's current interest rate environments, is if we see someone come in, they have a large amount of money sitting in savings, primarily savings, and they're at a large institutional bank. First question is, what's your interest rate? Because as many of you may know, interest rates right now are sitting a little over 5%.
You can get 5%.
Can get 5%. So if you're if your bank account's spitting out less than 1% interest, you might want to look elsewhere, at least looking at a high yield savings, maybe a money market. So to Mike's point, that's one thing. If we see that the high dollar amount in a savings account, I mean, she does have the CDs in there, so she has taken advantage of that to an extent, but we want to make sure that she's maximizing the interest that she.
You'd be surprised. It's remarkable, and we laugh about it when they call it the high yield money market is earning 0.1%.
Yeah.
And you do simple math. If you have $10,000 in a savings account earning basically nothing, if you were to able to earn 5%, okay, that's $500 a year, $40 a month.
Yeah. I mean, is it the most amount of money? No, but if I can get $500 a month or $500 a year for free, essentially. You
Right.
pay a little tax.
And that's only on 10,000.
Because you bet the big banks are getting 5% on your money.
Oh,
That's
absolutely.
what I always say.
Absolutely.
You know they're getting 5%. They're just giving you 0.1.
Right.
So you might as well get that 5% instantly.
Just be smart about it.
Yeah.
That's all.
Yeah,
Just simply,
exactly.
I mean, I'd rather get the interest.
Absolutely. Me too. So diving in a little bit to her investment allocation, she's sitting right about 80% stocks, 20% bonds. Her 401k is right there as well with 80-20. Her IRA was a little less risky at 65% stocks and 35% bonds. And then her non-qualified account is about 90% stocks and 10% bonds.
All right. So this is good, Nick. I think what we're going to do is, believe it or not, we're up on break already. So what we'll do is we presented that. We're going to come back to that and talk more about the investment allocation when we return from break. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're continuing on with the case study for Betty. Where we left off in the beginning, we had talked mostly about what she has, and of course, we went off on tangents, which I'm known to be able to do.
Some of her goals as well. Just what she came in here looking for.
Right. And so now one of the things that she wanted us to look at is her investment allocation. And we touched upon that real quick. She's basically, across the board, she's about 80% stocks, 20% bonds. That's a statement of fact. Okay. If someone opens up their statement and they see that the value of their account went down and they begin to panic, then they don't belong in 80% stocks.
Nope.
Okay. Long and short of it is stocks have the capability of going up a lot and down a lot. And if you can stomach the volatility associated with stocks, the rule of thumb is that over the long haul, your stocks are going to do extraordinarily better than most of your other investments.
And it also comes down to the time horizon because, we talk about this all the time. If you need money in 2 to 5 years, well, then you might not want to be taking the risk in the stock.
Correct.
Especially in the 0 to 2 year time frame, that's when we're really looking at cash. We might not even go bonds in that scenario. But with her, I take a look at hers. I know she can stomach the ups and downs. She's been doing her own investing for a number of years.
Right.
She built her portfolios herself, so she's relatively investment savvy. So for her, I'm not as worried about the volatility and her being able to stomach that. I'm looking at her allocation saying, okay, you want to retire in 3 to 5 years. Do we need to pare back a little bit?
Right.
That's kind of what we talked to her about.
So I've actually, and we just met with other clients all the time, and they feel as though they need to be extraordinarily conservative because, they say 100 minus your age should be the amount of money that you have in stocks. That's a rule of thumb. Okay, gentleman's 70. Okay, actually closer to 75, which according to that rule of thumb, they should only be 25 to 30% in stocks. But that's not always true. Okay, it all depends upon what your cash needs are from those accounts. And in this particular situation, he's got a couple $1 million and he only needs to be drawing like 30 grand a year. Yeah. That's like 1%. Mm-hmm. Okay, you don't have to have that much in there, but you take that into consideration. And what we do oftentimes is, as one way of evaluating what is the appropriate percentage of stocks and bonds and cash, is do a cash flow analysis. And we look 0 to 2 years, we're going to be putting in cash or money markets or super low volatility. Yep. 2 to 5 years, we might be putting in bonds. And then anything over 5 years, we will put in stocks. And then we may say 5 to 10 years will be conservative stock. And over 10 years, we can get a little more aggressive with that. Now, it's typically a starting point.
Yeah. And to your point, I think a common misconception is people, I'm retired, I can't take any risk. But what they're also forgetting is, for her, for example, she's retiring at 60. She might need these assets for a good 30 years.
Correct.
So you're still going to need some growth to supply the 10 plus year time horizon you're looking at, it's not just I need to be all bonds because I don't have income anymore, I can't take the risk. That's not necessarily the case.
That's
I
correct.
hear that all the time.
That's correct. And the other thing too is that even outside of that, you can also look at the tax factor. When the money is being held in a non-qualified investment account, stocks actually are very tax efficient. So if you're talking about an individual stock, you're only paying taxes if you sell it. And then you're only going to be paying taxes on the dividends as they're distributed. And regardless, if you have a long-term capital gain, which is holding it for greater than 1 year, or stock dividends, they're always taxed at a rate lower than what your ordinary income tax would be. So that's part of the allocation. So we look at overall allocations, but we will also take a look at cash flow, the investor's risk tolerance. If they can't stomach seeing their account value go down, well, then they need to be at a lower risk. And then we take a look at their taxes, and deciding which is the best bucket to be putting things in so that we can make so we can be as tax efficient as possible.
Yeah, I mean, we start off, we look at the big picture, the big pie, all the accounts, the aggregate of everything. We look at, from a diversification standpoint, what do we want to target? Do we want to be 60-40, 70-30? Then we break it down on an individual account basis. And if we know we're pulling a lot of money from the IRA in the next 5 years, well, that account's going to have a little bit more cash, bonds in it, because we know we're going to need that liquidity. So it's looking at the big pie and then kind of taking a look at each individual account and building that one.
Well, and case in point, an example is one of the other cases that we're working on right now is their cost of living is $130,000 a year. I mean, they're living, in Shenandoah and this, that, and the other thing. But the reality of it is that 70,000 of that is coming from their IRAs in the form of RMDs, and then 40,000 of it is coming from, it's more than that, it's like closer to 50, is coming from Social Security. So in all reality, their income is covering their cost of living, so therefore only really need to grab an extra $10,000. But the RMDs are 70,000, and guess what? Like it or not, that is a cash flow need.
Yep.
And so you have to take a look at the IRAs and say, hey, if we're going to be doing 0 to 2 years, then we take a look at what 2 years of RMDs are going to be, which is about 8 or 9%. We carve out 8 or 9% and have it in extraordinarily safe investments. Perfect example of why you do something like that. You don't ever want to sell an investment when it's down, because you have to sell more shares to get the same dollar amount. But look at what happened in 2022.
Yep.
Okay, 2022, both stocks and bonds were down. Stocks were down 19%, or shall I say the stock market. The bond market was down 13%. So there was nowhere to hide to be able to draw from assets that weren't down, except if you had a sleeve of cash. Okay. Now, it took stocks, about 6 months to recover? Something like that.
Yeah. I mean, by the end of 2023, they were
Fully recovered.
fully recovered almost, depending on the sector, but yeah.
And bonds still haven't recovered from 2022 yet. They're still down. Okay.
That's why you build in that cash.
That's why you build in a cash lead.
Liquidity.
Correct.
Absolutely.
So that serves as the perfect example. I certainly didn't like 2022 happening. But boy, I tell you, it serves as an example of why we do the things that we do.
It's a great case study.
It is.
In of itself, because people think bonds are not going to go down. I mean, they do go down, but generally not the same times as stocks. And if they are down, they're generally not down that bad. I mean, you talk about that all the time in terms of the bond market. So that's exactly, to your point, that's exactly why we do what we do.
Exactly.
Build in that liquidity for that 1 to 2 year time.
Okay. Now, where are we going from here, Nick?
I mean, we can jump in. So the employer benefits, we kind of talked about the investment allocation and some of the considerations we talked to with her. Jumping a little bit into her employer benefits. I know when we first introduced everything with Betty, we were talking about large company. My mind instantly goes to what are the benefits? What are the stock options? So in terms of what she has available to her, I kind of touched on it a little earlier before, but she has the restricted stock units, the RSUs, stock options, the employee stock purchase program, which is referred to as an ESPP, life and disability insurance, which is very common regardless of the employer, and then she has the 401k available to her.
So the 401k is typical. Life and disability insurance is also typical, except for maybe extremely small organizations, a mom and pop organization. But the ESPP, the stock options and the RSUs are definitely more typical of the larger corporations.
Absolutely. And she has all three available to her. So
Right, which is a beautiful thing. And so they each have their little own nuances. Some are greater advantages than others. I don't know, I just said
more advantageous.
Yeah, or greater advantages or more advantageous. Thank you very much. English was never my strong suit.
So I would do math.
Right, exactly. That's why I do math. So we're closing in on time on this particular episode. And since there is so much to talk about as it pertains to the employee program, the RSUs, the stock options, and the insurance, 401ks, and the ESPP, I think this would be a good breaking point
I agree.
for us to stop right now.
Yep.
There's no question in my mind we were going to carry into at least a second episode. It may even run its way into a third episode, especially with the way I talk.
We'll see.
There's a lot to talk about.
Yeah.
So thank you for joining us. And what we're going to do is we're going to take this into another episode and basically pick up where we left off on the employee or employer benefit programs. So thank you very much for joining us. Nick, thank you for joining.
Thanks for having me.
We will see you next episode. Thank you.